Welcome to the OPEX Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kachuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients.
So Brent, this is just the market that keeps on going here.
To say the least.
It seems like it just fights through everything and it doesn't really matter. And we should just get a couple margaritas, go to the beach, and I should shut down all the podcasts I'm involved in because there's no reason to analyze anything. It just goes up.
I would agree with you. That's but get levered long calls and go to the beach. That's the way to do it now.
Of course, when that does end, it doesn't end great, but at least you'll have a drink in you when it does.
Right, and if you just drink more, then you'll forget about the.
I think you'll forget it ever happened, right? It's a good strategy.
You're gonna win either way.
It's not just option strategies. We also have great life strategies here on the OPEX Effect.
Split your money between beer and call options, and you're gonna win either way.
Yeah, exactly. So you're hedged either way, right? It's a good example, like to teach people the value of hedging.
Make sure I get had a jailbreak there.
So we're going to talk about where we are here. We just went through a big options expiration in January. We've got a smaller one, but some interesting things going on with it here in February. But before we do that, we always like to kick things off by just talking a little bit about the OPEX cycle for anyone who hasn't watched our previous episodes. So can you just talk a little bit about how the OPEX cycle works and why it's important?
Sure. Thanks, Jack. So the general idea here is that as options positions build, we have, record call volumes constantly, record put volumes last year. So options volumes are increasing rapidly year over year over year. And so as that happens, the hedges associated with those positions should likely gain as well. And so there ends up being this cycle, which tends to be around 30 days. There's a larger cycle around quarterly expirations, so you get kind of a 3-month cycle. But basically options positions build up, the hedges with those positions build up, and then at expiration, a big chunk of options positions go away, and the hedges associated with those positions should move along as well. And what we found is that oftentimes, not every expiration, but a lot of these expirations, if you look back over time, in this case, we've marked all of the expirations that are red X, you can find that they become turning points or areas where volatility sort of either initiates and moves or changes direction. And this is sort of indicative of these different hedging flows. So, most famous examples are March of 2020, the stock market low there was obviously the Monday after options expiration. We saw something like that at the lows in June 2020. This past year, we actually had a high in July, right after a big options expiration. So you could see a lot of positions shift. What's interesting about this particular expiration that's coming up is that there's a tremendous call bid. And what I mean by a tremendous call bid is that we're seeing a bunch of different options metrics that show us that there's extreme levels of call buying, and that creates a lot of momentum. In this case, we had SPY 500 as this huge strike. The market has just ripped up into that strike as we sit here today. We have CPI tomorrow. But as the market moves up, these short-dated options positions in particular come and they form around, fill in around where, say, the S&P 500 or the NASDAQ is trading. And all of this creates this momentum. It helps to support stocks as the market moves up. And then conversely, in this case, when we have these big calls being bought at higher strikes, it creates this chase where dealers and market makers have to keep buying stock in order to maintain their hedges. And so that creates a lot of momentum or adds a lot of momentum or convexity to stock movement. And that's a lot of what we're seeing now. So, over the last month, really since December, over the last 2 months since December, S&P is up over 20%, I think it is. We're at this big magic 5,000 level in the SPX. And, there's a lot of positions sitting here and staged here. And it's a very interesting point for markets that we're going to discuss.
Yeah, it's interesting. Going back to the whole idea of them being turning points. I was talking to Jem Kersan on our other podcast recently, and this was really crazy to me. And I'm wondering if you agree. Like, he was talking about what you were talking about, which is the whole 2020 situation where, everybody saw COVID. COVID was out there. It was in Italy. Everybody's sitting here. Why is the market not going down? It just keeps not going down. And then we have OPEX and it just plummets. And, obviously there were dynamics of options that led to that, which we've talked to about in other episodes. But he was kind of saying, like, if that had played out a little bit differently, like, because the options flows were so important, like you could have gotten a completely different bear market there. Like if we hadn't broken down there, you could have had like a supportive flows after it. And, the whole thing could have been a completely, rather than like a huge decline and a huge back up, we could have gotten a completely different path in that bear market if things had played out slightly differently, thinking about the different probabilities, which was interesting to me, like how much these flows could potentially have an impact on how everything plays out.
Yeah, I think the takeaway from that is that options are leverage. And so, you can spend a smaller relative amount of money on a call or put, and that imparts or enforces a larger, buying or shorting requirement on the dealers and market makers that are hedging those positions. And so, just like to that downside into the COVID crash, there was a lot of people that were buying puts. There's a famous story. If you look at the end of 2020, Bridgewater, for example, bought a ton of March puts. And Ray Dalio said, no, we're not betting against America. It turns out that he just, imagine that guy having an incredible streak of luck there. And the market was crashing. I think they owned like 100,000 puts that expired in March, for example. So that means there's all this, futures have to get sold and stock has to get sold to hedge these positions. And then all of a sudden, expiration hits and those positions are gone. And in theory, then you have all of this hedge unwind that has to come back, right? And that's going to happen violently because if you're short stock and you got to cover that position, kind of like just in a margin call, you're going to do it as fast as possible, right? You're not going to wait and take your time. You have to hedge. If you have to hedge, you got to do it. You can't, wait on price a lot of times. And so I think that speeds up a lot of the market movement and really exacerbates a lot of movement. So, yeah.
Do you see any evidence like that people like decide to front run this now? So if they see an expiration like that coming and they know, these positions are going to come off and the market's going to be free to move either up or down, and those positions are all in one direction. Do we start to see it like in advance of the OPEX now because people see that it might be coming?
Yeah, it's a great question. We did on one of our recent podcasts together, I presented the stats around options expiration. I should probably update those, but you used to see, we started doing this in January of 2020, meaning publicly releasing a lot of data around these options expirations and discussing them. And you could sort of set your watch to like 2021, where we'd have these big call positions build up, market would rally a bunch, we'd have expiration, and the market would retrace some of those gains, like we'd consolidate a little bit, and then that dip would be bought, and we just continue that cycle. And then you'd also see a lot of times where the put heavy expirations would mark, short-term lows. And what you start to see is you used to be able to say, hey, Friday's going to be the day when the dynamic changes. And now what you see is oftentimes Wednesday, the dynamic will change a little bit more. And there's just a lot more, talk about it, right? I've been fortunate enough to be, in Reuters and Wall Street Journal and Bloomberg, and all these people are there. They talk about these dynamics. It's out there. And I think that if you can set your watch to these market movements, and the market is doing these sort of obvious things that, there might be dealers and market makers on the other side who have some negative edge around these events, and they can change the way that they're behaving, for example. So that could change the pattern of the way things are operating. And then on the index side, I think the other thing that is new is zero DTE, right? Zero DTE launched in November, really, of last year. November brought the full S&P, meaning every single day for the SPX index options, there's an expiration, but also spiders and Qs started expiring every day. And I think that added some new ways to hedge out possible exposure. Because if you think about it, on Friday, options expire, but positions could be settled or assigned and adjusted and shifted on Saturday. And so that's all happening in the plumbing right behind the scenes. So you may not really know your full exposure until Monday morning. You may have an idea of it, but I think oftentimes that exposure is not completely sort of shaken out until Monday. And so I think zero DTEs allow you to hedge a little bit of that exposure on the index side.
Yeah, we see this in like every area of investing. I mean, markets are complex systems, ultimately. And if there's an easy way to make money, like people, that easy way is going to change because people are going to go make the money. But by the other token here, like these are real flows. I mean, these are real things that impact the market. And so, they're going to happen, to some degree. Like, so it's as much as people are front running them or they're changing. This is not like something people have made up. Like these are real flows that have to happen, based on, dealers hedging themselves.
Yeah, absolutely. And as the options market, volumes increase, you can see positions or the way that stocks trade also increases as well. You can see volatility contract and expand, in other words, around options positions. We've done some studies around that. We also have tools that monitor intraday options flows, and you could watch the flows shift. As a stock rallies, for example, you can see call sellers come in and the stock will start to sell off, after that. So I think that, I think those flows are real. I think the other side of the equation is, look, there's only maybe half a dozen very large options market makers. One of the market makers, Citadel in particular, has said that you can find material, I think, on their site, or at least in a conference they did, that they say they do 40% of the options market flow. That might be a little bit stale, so put an asterisk next to that. But the point is that there's a couple of really big entities that do the bulk of the flow, right? The bulk of the trading. And so they have this informational edge, and I think they can constantly be shifting and adapting to how markets are trading, right? And the type of flow they're seeing and those kinds of things. So it's a dynamic game, but ultimately, these positions have to be hedged. They can't take unlimited risk. And so, the way that we have to track these flows constantly has to be updated and changed as well.
This is probably an impossible question, but do we have any concept of like how much of the total flows that are out there in the market, like how significant like option dealer flows are? There's probably no way to know that, but you just looking at it, you probably have like a general idea of what you think.
Yeah, I mean, you look at some of the delta positions in the market, and you could say there's billions of dollars of hedging flows associated with a name like Apple or Amazon or Tesla, right? And so you try to extract, well, how much of that actually has to be hedged, right? And then you used to look at it in the the SPX space and say, okay, how many futures need to be bought or sold because of this? Now there's 0DT that kind of obfuscates that a little bit. You can also hedge a Mag 7 position, maybe with some QQQ positions and different things like that. So, we see correlations in volume, but you're talking about billions of dollars of flow per day that has to shift and adjust, right? And, so for example, if I was to look up today what the biggest name is, I have Rocket Mortgage, for example, and over, let's see, a period of about 30 minutes, there was $5 million worth of delta traded in that stock. So Rocket Mortgage typically trades, 2 million shares a day. So that's $5 million over a window of about, 20, 30 minutes. So that, that's the type of thing that you can measure and analyze, and back out what the impact is, right? And so, the options flows in a lot of names, forgetting, Tesla, which has just unbelievable options volume all day long, every day. A lot of these flows, you'll see options trades will come into the market, for 10, 15 minutes, something like that, and then they'll go away, right? Or you'll have a situation like in ARM, right? The semi stock has gone up, I think, 80% this month or something crazy. And the options volume is going just bananas. And then tomorrow or the next day, the options volume will be gone. So it can be kind of episodic, I guess I'd call it, and shift really rather rapidly. But, you're talking about, generally speaking, for, mid cap to mega cap stock, you're, hundreds of millions to billions of dollars of daily options, of daily options hedging flows, excuse me.
So going back to the next slide with the current expiration, a couple of takeaways, I think, and you can correct me if I'm wrong with either of these. Like, it seems like this is a smaller expiration than the one we dealt with last month, but it also seems to be a little more maybe call heavy, although I think they're different types of calls. So maybe you can explain that part of it.
Yeah, so I skipped ahead a couple charts, which I think shows us better. In orange here is the call positions and blue is puts. And so you can see that for February options expiration, it's a good size expiration, but this is not as big as a quarterly expiration. March is the really big one. So if you're just listening to this, February is about half the size in terms of delta than March, which is the quarterly. But the other takeaway is that you don't see any put positions on any of this on any of these charts, and obviously that's because the market has rallied so much. And so delta is driven by in the money calls. So if you think about someone buying a call and then that call, goes up sharply in value because of the market rally, that's really what increases the delta of a position. And so, this is what we like to refer to as a call heavy expiration. This is a little bit different than the January, or a lot different than the January expiration, because if you remember from the January conversation, and we'll go over this in a minute, but that the January expiration was driven by these long, these leap positions, right? Like the Nancy Pelosi trade. She'd buy these calls and then they would, over the course of a year, go deep in the money. these February positions are short dated, meaning that somebody bought these, weeks ago, maybe at best. And there's been a real chase. So people are really running into these call positions as the month gets closer. More call lines pick up at this month. And that's part of this whole chase. And so what you have now is a stock up, vol up situation, which is not that much unlike what happens when the market crashes and the VIX goes up. Now what's happening is a lot of these stocks are actually crashing up. And that's quite a bit different from, the kind of 1 year rally that we had that drove an increase in January call values.
Do we know if Nancy bought the Leafs again for next year, or I don't know if we found that out yet?
I didn't see that. I don't know. Is she still in office? I'm
Yeah,
not sure
I believe she is.
position, right?
But yeah, she's probably the biggest call, to determine whether the year is going to be an up year or not. We got to find out if Nancy purchased the Leafs or not.
Yeah, we should go and check that. I know that's a big thing now, tracking call positions and the people's jets. I think are the two big things.
I've seen there's been some issues around the Jets with Taylor Swift and the Super Bowl that she wasn't pleased with the tracking of the jet.
Yeah, we got the obligatory Taylor Swift mess, or just like the Super Bowl. Historically, what you see is that generally, this kind of ties to what we were just talking about, but generally you have, when call positions build up in the S&P 500, that brings what we call positive gamma to the market, and that's to the right of this chart. And what that generally means, if you're listening to this, is that volatility tends to contract in the S&P 500 when you get more and more call positions. So historically, you have call overwriting as the predominant flow in the SPX. So that means the dealers are buying calls, and that really shrinks volatility. And then as we move to the left of this axis and people start to buy more puts, volatility expands. And so this chart shows you what we call today's gamma reading versus forward 1 day volatility. And you can see there's a real correlation there. There's a very high correlation there. So what is a little bit different here is that there's more people buying calls arguably than what historically tends to happen. And so what that means is that there's a little bit more stock that has to get bought in the S&P when the market goes up. And so there's a little more volatility to the upside than what we've normally seen.
Have we seen volatility going up a little bit? I mean, have you seen, I know you can see like things like fixed strike vol that I can't see. Have we started to see a little spike in volatility with the rally?
Yeah. I mean, you could just look at the VIX, right? The VIX is at 13.5, and, there's a VIX expiration on Wednesday, which can often shake things up. And so the VIX has been very stable at that level, and implied vol has been at, 11-ish, 1 month realized vol has been at like an 11, where generally what you would see if the market was rallying like this is you'd see that volatility would contract, right? You'd see realized vol go to like a sub 10, right? You'd see the VIX start to really break down to that 12 or 11 handle. And so what's happening now is the explosive move up in the market is actually this sort of stock up, vol up thing. That is indicative of what you'd see if there's a lot of call buying and dealers having to chase.
Is there any truth to the idea that if you see stock up, vol up, or market up, vol up, that's a sign that things are potentially going to roll over, that's like a bad sign?
Yeah, I think so. And so, I want to preface that by saying there's a difference in that we need to have a correction, right? Which, we could have a 3% correction next week, which would only take us to 4,900 in the S&P 500. We're trading around 50-50 right now in the SPX. So that's nothing, right? Like literally 4,900 was last week. But the point here is that when you have these chase scenarios, stock up, vol up, the corrections can be very violent. Now that dip could very well get bought, and then later this year we make new highs. But the point is the same: is that if you have this chase to the upside, when that chase snaps and breaks, you get downside momentum that can be just as violent. If you think about this axiom that the biggest rallies occur during bear markets, right? It's the same idea, because these puts drive markets lower, the puts roll off, and there's a giant short cover rally. And then when that short cover rally drives up, what happens? The market sinks back down and you have another big down day. So, you can have this massive volatility when you have stock up, vol up, or stock down, vol down. When you have that long volatility move, that works both ways directionally. In other words, again, stock market's been up 5% like in a week. Well, it could go back down 5%, very quickly as well, because the flows are chasing.
So this next slide you have, I guess we're going back a little bit but we have the range bound into January OPEX here.
Yeah, and I want to look back into January options expiration because we held this very consistent range, right? And what happened was you were ping-ponging off of these levels, and then at January options expiration, as soon as all these leaps expired, we had the view that there could be some downside consolidation after that big January options expiration. And instead, what happened, as you can see in this chart, that right on that day, January 18th, the options expiration, the market just launched, right? Volatility completely expressed itself to the upside. So we were at 4,800 back just a month ago. Now we're up at 5,050. It's just been an incredible market rally straight up right after that VIX expiration, January option expiration window. And so, it's kind of funny because we're thinking, hey, vol's going to increase here. We think that's going to bring some weakness to the market, and we got volatility, but man, has it just been completely expressed to the upside, really rather violently. I don't know how else you call this, but just a violent stock market rally to these new highs.
And it gets at what you talked about last time. Is you talked about last time we potentially were going to become unpinned. And that works both ways, I guess. You could get unpinned to the downside, or you could get unpinned to the upside, and in this case, it went up.
Yeah, and the volatility, you could mark it to the day, right? We literally broke out over that 4,800 level on January options expiration, kind of into the close, and just absolute. So to your point, it unpinned for sure. Just really, again, rather violent to the upside when we were looking, admittedly, for a little bit of a move lower. So we're back here, and I'm laughing about this kind of boy who cried wolf scenario because I'm saying, hey, I think we're due for another correction here. I'm going to get into why. And the dynamics are a little bit different, but I do realize that, hey, we say, hey, we think there's going to be some weakness in January. We didn't get it. We got a lot of volatility for sure. But again, the dynamics are really leaning heavily, I think, for a period of consolidation here. So we'll dig into that.
I'm just curious, are the quarterly options expirations always bigger? Like, can there be a situation where there's a weird thing going on where like February can be bigger than March, or are they pretty much the quarterlies are always bigger?
The quarterlies are always bigger. A lot of the bigger institutions will put those positions out because, rolling those positions is a transaction tax, right? And so they got to work with a dealer on the other side to put up these big positions. So they like to put them on. They'll systematically roll those positions every quarter. And generally they don't close those positions when they're in the money, right? They don't adjust them. So like we mentioned Bridgewater before, they'll buy their 100,000 puts and they just leave them on. And when they expire, the SPX index options are cash settled. So it makes it very clean. The dealers that they're working with to help manage these positions, I think, like that because if they're trying to flip flop in and out of these 100,000 lot, put positions or call positions, dealers got to hedge that. They got to adjust their books. It creates a lot of kind of just, I think, chaos oftentimes. So usually you'll just get the quarterlies being the biggest. There's always a lot of big put positions on in December, just as people hedge for the year. January, you get the leap call positions, and then all the other months inside of that tend to be generally smaller. There's not a whole lot left when you take out January and the quarterlies, but the other half tend to be a little bit smaller.
The other thing I noticed in this chart is we once again have the VIX expiration before OPEX for 2 months in a row. Like, how are you thinking about that, and if that matters as we head into February?
Well, the size of VIX positions, it's been argued they've increased. And I say it's been argued because I think depending on how you look at it, whether you look at it open interest or some people try to measure it in some different ways, VIX hedging right now seems to be more impactful to the market. And so, if you think about these options positions, that cycle that we talked about before where positions come in and hedging flows start to build up around these positions and it kind of stabilizes the flow, right? In other words, we're moving up with a lot of momentum right now because there's a lot of this negative gamma hedging. So stocks continue to go up and people continue to buy, or dealers and market makers have to buy stock to continue to hedge. Well, if you have a lot of VIX downside right now, there's a lot of volatility selling. And so the general idea is that when you hit VIX expiration, that destabilizes the current trend of flows. So, usually you'll have, or I shouldn't say usually, oftentimes you'll have equity options expiration before VIX expiration, right? And to me, it doesn't necessarily always matter except for, the VIX expiration could be the following Wednesday. So when you talk about when will position flows start to destabilize things, when VIX expiration is before, I think that the window for destabilization or a change in flows then, opens with the VIX. expiration, as opposed to sometimes if you have the VIX expiration after OPEX, then, it may delay a little bit some of the changing of those OPEX flows. So that's what I think the significance is. One of the things that was interesting, and I think I have a chart on this when we look at the what's moved segment here, is VIX expiration last month. We saw the VIX suddenly spike from around, as you can see here, we were down around the 13 handle, right where we were now, right? And the VIX popped up over 15. And there was, I believe it was the largest VIX call premium spent ever for, I think it was even February options expiration. So there were these huge VIX call positions that got rolled that brought just a touch of market weakness, but the VIX suddenly spiked. And I remember that because I was feeling great that the market was getting weak around this window that we were pointing out. And, I have a lot less explaining to do. What the market just does what I think it should do. Whereas, in this case, we're coming back up with the VIX almost exactly the same level, right? Literally 13.4 right in that general area. But the S&P's 200 points higher. Whereas generally you think that vol would come down, right? You'd think that VIX would be closer to like, say, 10 or something like that if the market was going to rally that much. So that kind of backs the stock up, vol up situation here. But this also backs up this idea that the VIX expiration can be this moment where volatility can start to shift and change and even bump up, right? And again, that happens Wednesday. So we have CPI tomorrow. I'm not a macro guy, but the volatility associated with that print has come down a lot. People's expectations about how it can hit the market has really dropped significantly. So at the money IVs for tomorrow for the 0DTs, I think around a 12% right now. Those were in the 20s not all that long ago. So people don't think it's going to be as impactful anymore, which I think is probably, I don't have a bone to pick with that. But if there is a little bit of a hot print or something like that, there's very little room for error in terms of what people's expectations are, right? People are expecting, 50, 60, 75 basis points maybe of daily movement in the S&P. If you get a hot print and we print a 1% move or at least a 1% move in the underlying index, then suddenly that can cause a scramble for long volatility. Or said another way, it could cause short volatility players to have to scramble for cover, right? Because if you're betting on a 50 basis point move in the market and suddenly you're served up with a 1% move, well, you're taking some pain and you have to generally cover that position.
On that idea of the big VIX call buyer in January, that's something I always screw up. Like I always think like if someone's doing something like that, it's got to be some massive warning sign, like this huge position was taken. And, a lot of times I think I'm probably completely wrong about that because you don't know what's on the other side of that. I mean, you don't know if they're hedging some other position they have, or you don't know if they're just going to be outright wrong. In this case, if there was a big VIX call buyer, it didn't spike like they expected. But I always have that tendency, you get those things in the news. It's like, oh, big news. This huge position was taken here. And without context, I don't know that it tells you all that much.
Yeah, I think you're 100% right. A lot of these flows are people hedging a portfolio or, doing something simply because it's in their mandate as opposed to an expression of bearishness. The most famous, I think, VIX buyer is 50 Cent. That person specifically, I think it was a European fund manager, was, trying to express a trade and generate alpha from the trade as opposed to hedging something. And the general idea there was he just kept buying VIX calls that were 50 cents. I think they'd generally be like a month out, right? And he was spending every month, he'd spend this premium every month. And then suddenly, finally, the VIX spiked and he made a killing. And a lot of people are very comfortable with that payout structure, right? I'm going to lose 9 times out of 10, but that time I'm right, I'm going to just knock the cover off the ball. Most people want it the other way, right? Like I'm correct 9 times out of 10. I'm just making a lot less. Then the problem is that one time you're wrong, you lose, your shirt. So there are all these different dynamics in the VIX trading. Certainly there's some people trying to generate alpha from that bet that the VIX will spike. But I think a lot of it is just hedging flows that are coming to the market. And again, not necessarily an expression of, hey, tops in, right? It's just a hedge.
Is the 50 Cent guy still out there?
That person stopped at least doing what they were doing. I think after that, I believe there was a trade that looked like that flow not all that long ago. But as far as the systematic buying of those 50 Cent options, that hasn't been around for a while.
So as we move to, we did a little bit of this, but as we move into our What's Moved segment here, we always like to take a look back at what we said from the previous one before we talk about some of the things we're seeing for this one. So
that's right.
Yeah, here are your views going into the January OPEX.
Yeah. So the first line is funny because I said, I think volatility was at major lows, and that's what a lot of the presentation was about. Look at how low volatility is, blah, blah, blah. And we thought that would lead to a volatility spike. And because there were these big in the money call positions, we thought that hedging flows could kind of lead to an unwind of or a correction in stocks, I should say. And so what I did here is we talked specifically about these 4 stocks: Meta, Royal Caribbean, Pan W. I'm drawing a blank on the name of that stock right now. I apologize for that, in NVIDIA. And so what you could see here is that what I thought was interesting about this is that you could see here's the black line is options expiration. And like Royal Caribbean topped almost to the day. You can make an argument that Pan W also actually topped, at least up until last week. They had, I think, good earnings and it spiked a bunch. But, you could see an OPEX inflection point, I think, there with several of these stocks that seemed to last for the 2 weeks into February. You can see that the momentum of these names at least shifted quite a bit. So, look, I thought this would actually lead to much more downside performance. I fully admit that. But now a lot of these stocks are up, in the case of NVIDIA, it's up, 30, 40% since in a month. So it's really pretty crazy. And again, we just talked about this. The VIX did spike January. We had this moment after FOMC where things really started to get weak. They looked like, hey, this could be it. We're finally due for a correction. And put sellers came in, vol sellers came in, and the market just never looked back from that test of 4,700 right after FOMC.
Yeah, and this gets to that whole idea that there's a bunch of different things that generate flows in the market. You can see on the Meta chart, Meta had ridiculous earnings. So obviously that type of thing can overwhelm whatever might be going on in options world, if a company just reports blowout earnings or something like that.
Yeah, and I think, when I look at this chart, I say, okay, Meta was up 15%, call it, from January 1st into options expiration. And then it was only up 4% from then to earnings, which is another 2-week window. So, the momentum did, I would argue, tail off there for sure from what we saw in the beginning of the year. I'm certainly not going to stake a flag in the ground and say, well, I was kind of right with a bunch of asterisks around it. I thought there would be more convincible weakness, but you could see that momentum really tail off. And I bring that up now because the momentum we've had in the last week or two in particular has just been explosive, in all these names. There's so many names that are 40% in the matter of a couple of weeks. So, this is a very extreme dynamic that I think, shows in a much different way than it did into January options expiration.
So in this vol gets sold into weakness. What are you showing there?
Yeah, so this is our fixed strike vol grid. It's one of our new tools that we just launched. And what you see here is you see strikes across the x-axis and you see expirations are on the y-axis. And the general idea is that if you see red, that's telling us that volatility is down. In this case, it was day over day. So what we did is you can look at vol, and this is what we say on a fixed strike basis because we're looking at the individual implied volatility for each strike at each expiration. We say, okay, what did that look like the day before FOMC and then the day after? So we compare fixed strike vol. And so what was interesting here is that the stock market was down 1.5 to 2% from the highs the day before the FOMC to the lows into FOMC. But what you can see in this grid is a big shade of red. And so what this tells us is that even though the Fed came out and seemed to kind of spook the market a little bit, vol was getting sold, which tells us, particularly at lower strikes, as you can see here to the left of the grid, people sold vol into the event, or into the move, I should say. And so if you had thought that the FOMC had actually changed the paradigm or said, hey, whatever Powell just said is really starting to scare traders and that could start this downward spiral, you would see that expressed with shades of green across this grid, right? Which would tell us that people are buying puts, that there's demand for volatility. In this case, the sea of red tells us that, yes, the market got 2% weaker, but people sold puts into that and sold volatility into that, which is really supportive. And as a result, market rallied about 2% the next day, 2.5% the next day after FOMC. So the move specifically from Feb 1 to Feb 5th was up 2.5%.
So this is a good tool to decide, like, is there real fear out there? People might talk about there's fear, but this tells you in like the real world, are people like with their positions, are they expressing fear?
Yeah, that's the value of fixed strike vol, because when you look at an indexified measure of volatility, like the VIX is incorporating essentially, the at the money volatility. Well, the at the money volatility is whatever the index level is trading at, right? That's the volatility of wherever the index is trading. So if the index goes up 2% or down 2%, that at the money input is changing as a result, right? And so what happens in the VIX is it starts to incorporate skew a little bit. It's not actually telling you how vol has changed. It's just sort of like sliding up and down, what we call skew. So generally puts have higher implied volatility than calls, right? That's the whole smirk that appeared after the 1987 stock market crash. So what happens is anytime that the VIX goes, the stock market goes down, the VIX starts to naturally include these put options, which just naturally have higher implied volatility. So it's not that volatility actually went up. It's just that the calculation or the input into the VIX calculation itself changed, if that makes sense.
Yeah.
So when you look at it on a fixed strike vol basis, you kind of take out that moneyness out of the calculation, and you can actually see how stuff is shifting under the hood, so to speak. And so, I think on this day, the VIX was up, 1.5 to 2 points, but fixed strike vol was down. And so that told us that, hey, look, people are selling vol into this downside.
And is that what this next slide gets at? This idea that the VIX implied fear, but it was wrong?
Yeah. That's exactly right. If you go back, you look in Twitter, you'll see, hey, there's this sign that vol's perking up, vol's perking up, vol's perking up. And that wasn't the case at all, right? And if you'd listened to that fear and you got kind of like pulling into that, you would have missed this really sharp rally that told us that, no, what's actually happened is people are selling puts and selling vol into this market weakness, which could really kind of almost like a slingshot. You kind of pull it back a little bit. The harder you pull it back, when you let it go, the farther, your rock goes. And I think that's kind of the same thing here. Like when the market's coming down and people are really starting to sell that vol, it's like a slingshot and can really pull things, pull the market up.
Yeah. So as we move on here to our what's moving, we'll move forward instead of backwards. What do you what are you seeing this time?
Yeah, thanks for indulging us with the review. I think it's important to do that to keep things honest and to see what's happened, because our periods come up here, our windows to have these conversations come up just so fast now, but you forget all that goes on. So I think it's interesting to set the stage, and now we have an interesting situation because the VIX actually picked up a little bit the last 1 or 2 days, but in general, if you just zoom out a little bit, vol has come down significantly, obviously, from the 2023s, where the VIX was really stable up around the 20s, even really post-COVID, right? These are post-COVID crash lows in VIX. Even a VIX of 13.5 is, as you can see on this chart, those are pre-COVID crash levels. And what I think is interesting here is that we're the only period of time that's essentially where the VIX is below where we're trading now is December of 2017, which was just this anomalous year. In fact, the lowest ever 1 month realized volatility. So if you think about realized volatility as a measurement of how much the stock market has been moving, the lowest amount of movement ever was in October of 2017, where realized vol is 3.5. Realized vol right now is like an 11. But, these are normal levels of VIX, I call it. We're getting kind of more or less normal movement of the VIX, but, we've really pulled back to levels that have now erased the COVID crash. And the market is not pricing in really any risk. So as much as people wring their hands over geopolitical issues or commercial real estate problems or, hiking rates, all these other things, elections, people really are not pricing in much risk at all going forward in time. And so, that's what the dynamic is. And in fact, we have another slide here where if you look at the cost of downside protection, it is lower than it's been arguably, at least in modern times, right? The skew index that we look at is called the SDEX. It measures a 1 standard deviation spider put relative to the at the money put. So essentially, what is the relative price of a 1 standard deviation 1 month spider put? And as you can see, this index is well below anywhere it's been in the last certainly 5 years.
So that's interesting. So it's actually cheaper than it was in 2017.
Yeah, and
why would that
be? Because I think what you get now are you get these put sellers that come in. You also have a lot more expirations now, for example. So whereas you would get volatility selling back then with some of these VIX ETNs and different things like that, now I think what you actually are getting are put sellers in the S&P 500 itself. And so that is shifting these prices around. So you have this kind of double whammy of at the money implied vol is coming down, but also that out of the money put relative to the at the money put is also sliding down. So there's also a little bit of the shape of the skew in this index a little bit. But this is also markedly showing you the 1 standard deviation out of the money put. So again, no one's interested in really owning this stuff at all.
Yeah. So on the next slide, we're talking about the right tail chase.
Yeah, and so a lot of people look at the skew index from the SIBO, and there's some good qualities of that, but I just wanted to show the SDEX is the index we just talked about against the skew index. The skew index includes call options in it in its calculations. This is the SKEW from the SIBO, and it can create a little bit of noise. And I don't want to say incorrect calculations. It just doesn't always behave the way that you would think. It may be telling you the wrong thing sometimes. So what you see here is that the skew index from the SIBO is up actually at recent highs, right up around 156, whereas that SDEX, which just measures puts, is making fresh lows. And so again, there is, vol is coming down on a relative basis, but if you think about skew in terms of the way that a call is measured in terms of value relative to a put, calls are increasing relative to puts. So there's this three-dimensional aspect of this, right? Like vol overall is coming down a little bit, but calls are catching a bit relative to puts.
I wonder if, has anyone ever studied like what happens when these things deviate? You see they track each other fairly well, but then we've got a pretty big deviation. I wonder if this is like a warning sign or something like that.
Yeah, I've never looked at the skew versus the SDEX. That's actually interesting. People have looked at the skew as a measurement of forward, S&P returns, and it's not terribly effective. I think if you combine with a couple of other indicators, maybe you can find a little bit of edge. But I've not actually compared the difference between these two. I'd have to look at that. That's it's an interesting idea. Thanks, Jack.
I'm going to be like an options guy now.
I wanted to talk about these call skews. So this is the feature of the market that is most dominant right now. It's the most interesting thing. And, if you look at Zero Hedge, they'll post articles from Goldman and some of these other banks, and a lot of listeners here are institutional folks, and they get access to these, bank notes, research notes. You'll see that this call skew phenomenon is something they're all talking about. The SIBO just put out their volatility piece from Mandy Zhu, who's their analyst, and she's talking about these call skews. She called it meme mania level. And essentially what this is telling us, or what the skew is measuring, is, again, what is the implied volatility of a call, let's say a 5% of the money call versus a 5% of the money put. In this case, we're using delta to measure, but I'll just use a percent money just to illustrate. So the idea is that the more demand there is for calls, the implied volatility of those calls goes up relative to the put. And so what we can see here is we rank these on a percentile basis. We rank skew. So the more positive skew is, the more call tilted it is. And then on the left axis here, we have IV rank. So what is at the money implied volatility in terms of a rank? So what you can see is that because earnings has by and large come out for a lot of the biggest names with options, a lot of options flow, implied volatility has come down overall, but skew has increased. So remember before I talked about volatility is coming down, but the skew is pivoting, if that makes sense. So what this essentially tells us is that, earnings is passing, but the call demand is significantly outpacing the put demand. And it's doing so at a level where we're hitting 90th percentile rankings in our skew rank, which goes back over the last year and says, hey, when, how does this call demand measure up versus the last year? And what you could see here is that we're in the 90th percentile for most of the biggest stuff that trades, right? Most of the stuff with the most volume. And you can see that's what this yellow dot is telling us, right? This yellow dot all the way to the right of this chart is informing us that most of these stocks that we're looking at have high call skews. That tells us that there's demand for these calls. That tells us that dealers are likely in a negative gamma position, which means that as stocks go up, they have to buy more shares of stock in order to maintain, right, the hedges on their calls. So I thought this list was really interesting. In yellow is AI-related stuff. So Soxal, which is the triple semi-ETF, right, the leveraged semi-ETF, that's a 99th percentile skew. Taiwan semis here. SMH, the sleepy old semi-ETF, 98th percentile skew. So, these call ratings relative to puts are higher than 98% of the time that we've seen all last year. Marvel, 98%. ARM, that's the stock that's gone up, I think, 40, 50%, 80%. I don't know what it is at this point in the last 2 days. NVIDIA, all these extremely high call skews. A lot of people saying, okay, semis makes sense. Well, the Mag 7s, you got Amazon, Meta, Apple, all very high call skews as well. Then you're seeing stuff like this, ARC, 99th percentile in ARC. So we're filtering down now to the stuff that you could say is probably the most speculative as well in some of these readings. And then, of course, you got the crypto. Crypto stuff is just going absolutely off the charts today. I don't know if you looked at Mara or MSTR or Coinbase. Coinbase at the start of the year was at 190. It traded down to 110, and now it's back to 150 all in the course of a month. So this stuff's moving like crazy. And then last but not least, IWM, 94th percentile call skew, triple Q ETF, the triple long NASDAQ, that's the 92nd percentile skew. So all of this stuff is very heavily tilted towards an aggressive bullish stance. And the issue with that is that when you have this situation where essentially stocks are crashing up, which is how I'm viewing it, as soon as that momentum stops or the positions change a little bit, then the hedging flows associated with these positions should also change. So, like if you throw a rock up into the air, when you're watching it go up, you go, well, this is going to keep going forever until it suddenly slows down and then reverses and comes back down. So I don't want to sound hyperbolic in that I think that we're going to unwind these gains that we've, 80% gains in some of these stocks. This is a situation where I think we have a 3 to 5% correction, and you would expect dip buyers to come in because a lot of people probably have FOMO and are looking for their entry opportunity. That's how I'm sort of operating, or what I'm thinking about. But this momentum right now, it's such a momentum trade. So when you turn that momentum or you switch that momentum off, you can get a pretty meaningful correction. But again, 3% down in the S&P right now just takes us back to literally where we were last week. So that's not saying a lot, except for that this has gotten very rich to the upside and, starts to run on exhaust, I guess, at this point. And so you need some consolidation to help, rebase things.
So when you talk about negative gamma and dealers having to buy on the way up, the idea is that's what's kind of going on now. But as we go into the expiration, those positions are going to go away. So that need to continue buying on the way up is going to go away as well.
That's correct. So if you let's say you get a shot across the bow with CPI tomorrow, for some reason it's hot and hotter than people are expecting. That's one way to do it, right? Because suddenly people go, rates may have to go up, and that can turn the dynamic around. The second one with the options expiration, because you have all these calls, which when you have high implied volatility like this, those calls are going to have a very high rate of decay in the February options expiration. And there's, while it's not a quarterly expiration, it's a big expiration for a lot of these stocks, enough to turn the tide or lead to some consolidation. And so, when the vol comes down, the rate of hedging, this is the Vanna trade, vol comes down, it changes the hedge ratio and it leads dealers to have to start selling stock off as the stocks come down. So that's what the general idea is. And, to give you an idea on that topic, I had done this study a couple of weeks ago, just to give an example. We were looking at the delta of a 190 AMD call with 2 weeks to expiration. This was into their earnings. So the IV of the option at the time was 75%. That's roughly, this is called a 30 delta. If you shift that vol up of that option up to 100, you can see the delta goes to, let's just say 40 for sake of argument. And then if you drop the vol down to 50%, you can see that the delta goes 20. So if you think about delta as the rate or the hedge ratio, you could see how a shift in vol can change the hedge ratio, right? So right now, if we're extremely bullish and we need, let's say, 30 shares of stock to hedge out this AMD call option, and the vol stops, right, because the stock stops going up at such a high rate of at a high pace, as soon as the stock stops going up and vol comes down a little bit, that delta immediately drops, let's say, by 10. So I have to sell 10 shares of stock. So you can imagine if you extrapolate that and say, okay, put this against hundreds of thousands or millions of calls across the market, you could see when this vol stops, right, instead of having vol up, stock up, we just have market flat, vol comes down, then suddenly those calls stop being so expensive. You don't need as many shares to hedge them anymore, and you can start to unwind some of those long stock hedges, and that can press the market lower.
That makes sense. So in general, I'm just thinking, when you have these expiration weeks, and you have these stocks that are, where the dealers are buying on the way up, is there like a typical point where that peaks? I mean, does that peak at expiration, or does it peak earlier in the week? Or I guess there's a lot of factors that probably determine that.
There's a couple of factors in that. And what I would generally say is Wednesday, Thursday is where I see it peak historically. And you could see this in particular the meme mania days. It changes a little bit in terms of like, well, is there earnings going on? A lot of people now just come in and out of options on the same day. But I would say generally it's kind of people would get long calls on Monday for this week. And then Tuesday, you'd see kind of that a tilt towards long action. And then we start to get to Wednesday, Thursday, Friday, the decay of those options starts to pick up a lot, right? Because they're advancing so rapidly to expiration. And so, we had done some studies that are a little bit older now, but that's generally how I look at it is you start to lose that momentum on really into Thursday and Friday in particular.
So these next two, you have a similar chart, but you looked at SMH and you looked at NVIDIA.
Yeah, so I wanted to, here we said, hey, 98th percentile skew, what does that look like? This is part of our new volatility dashboard. And what you see here in green, the green line is 1 month, so 28 days to expiration specifically, skew for SMH. And what you can see is that the 110% out of the money call, let's just say, it has a higher implied vol than the at the money call. This is very unusual for a big ETF like this. And that shaded cone that you're looking at is the net 90th to 10th percentile reading over the last 60 days. So what this is telling you is that there's this call skew in SMH that is significant, right? Because it's much higher than what we normally see. Now, this is due, the after earnings, right? Most of these semi stocks are just going bananas, but a lot of this is due to NVIDIA earnings, which are on 221. The expectations for NVIDIA earnings, they're insane. This is NVIDIA skew here. What you can see here is that the 110% call is much higher, right, than the at the money call. So this is, when we say call skew, it means that out of the money calls have a higher implied vol than the relative put, or the at the money, some people, depending on your definition, is. So you can see there's a clear, it looks like a ramp, right? Like a skateboard ramp or ski ramp or whatever it is. Whereas if you historically look at the S&P skew or SMH or some of these bigger ETFs, it generally is completely downtrending the whole way down, right? You generally don't have this flattening out or elevation into the call side of things. You almost always have what looks more like a straight kind of 45-degree angle down. So in this case, we have just extreme expectations. I did a chart today I put on Twitter. If you compare this to what it looked like in the earnings in November, you would have to drop vol, probably 30%, just a deflation across the board. And then, the call skew looks a lot more as like SMH. So the point is that people are extraordinarily bulled up into this NVIDIA expiration. And look, semis after they've been reporting, those stocks have all been going crazy, but NVIDIA's up 40% in the last couple of weeks, right? On top of the stock already being at a year time high. So you have just expectations that I think are extremely hard for NVIDIA to fulfill, right? They could beat earnings, but traders are pricing in not just a beat of earnings, they're pricing in, to be honest with you, I don't know what NVIDIA would have to do in order to justify beating this call skew, right? Because what happens is, as soon as they report earnings, implied vol goes down. It's just a function of the event passing, right? And so immediately you have to start swimming up against the tide if you're the NVIDIA stock, because that vol is coming down. And if you remember this AMD example, vol coming down immediately. So if you have all these people piled into calls and that call implied vol drops just as a function of earnings passing, there's this stock that comes for sale just as a function of that vol changing. So, there's a big heavy tide against NVIDIA to swim against. Doesn't mean the stock has to go down 10% after earnings. It just means that, look, the stock's up 40% already. The expectations are incredibly high, and it's going to be very hard for it to jump over that hurdle. We saw this after AMD earnings, for example. I don't think I have the chart in here, but AMD was down, I think about 5% after earnings, and it rebased, and I think it started to move back up against that a little bit. But the point here is that you have such an extreme level of bullishness that it's hard to fulfill those expectations, and the flows will just naturally start to turn against us.
Yeah, what you're getting at is one of the things the options market could teach all of us about. You'll see this all the time. Like people will be all excited. I own NVIDIA. They'll look after hours. They report these great earnings. They'll be like, all right, I'm really pumped up. And then they look at the stock price and it's like the thing is just tanking. And so much of this is like these flows that are going on behind the scenes, plus the expectations that are kind of embedded in there, relative to what the earnings estimate is for the, in the real world. Like all of that can help you understand that like a lot of times you're going to get these situations where you get what you think you wanted to get and it doesn't work in your favor.
Right, because it's a crowded trade is what the summary of it is. Like everybody, no one wants to be short NVIDIA in their earnings, right? And so what I did on this chart, I'm breaking from the presentation here because this just came up, but I flagged the last 2 times that we had skew kind of this heavy or high into NVIDIA earnings is what these 2 black lines are. And so, you have these incredible moves into these earnings events, and in one of them in October of 2021 or November 2021, like market reversed high, but hard. But that was when interest rates were increasing and it was a little bit of a different macro environment. In June of last year, after the huge AI run, remember everyone was bullish on AI into June and July of last year, market actually sold off pretty good into August. NVIDIA held up. But the point is you could see how hard the stock ran. I think in both cases we're up, we can just measure it out here right now, right? So you had a 40% gain into the earnings in November of 2022. Depending on when you want to strike the measurement here, 60%, rise the month or 2, maybe 3 months into earnings in June of last year. And then obviously, since January 2nd, the stock is up 47% into earnings. So again, you can see the moves here and this call skew so elevated, and you go, look, stock's up 40%. People already assume that they beat. It's a very, very, very crowded trade. And I think, that's the way to summarize what I'm trying to present here is like, look, this is an overbought crowded condition. It needs some consolidation, and a little bit of cooling off so that, if it's going to resume, then okay, maybe it resumes. But clearly we're overheated.
Yeah, this next one is very interesting because you're looking at the S&P 500 and all the weights, and we had a growth manager on excess returns recently, and they were talking about this idea because they were like, well, what do I do? As a growth manager, let's say I like Microsoft a lot. They're like, what do I do? They're like, I have to just to basically match the index, I need to have a 7.3% position in Microsoft. And, a lot of people who manage funds have rules in terms of how much they can own. So it almost becomes like especially with these bigger ones, Microsoft and Apple, it becomes very difficult to even express like a bullish bet relative to the S&P 500 because the weights are so big now.
Yeah. And I think that's where options maybe can help. I mean, I don't know if a lot of these managers can even do that because you can maybe scale things a little bit differently, but it's very crowded tech trade. That's no secret here. What I found was fascinating about this is, of course, the Mag 7s are on there. NVIDIA is now 3rd largest component of the S&P 500, but Broadcom's number 10, which caught me by a little bit by surprise. Tesla's now out of the top 10, and then you have AMD's now cracked the top 25 here. So these semi stocks, as well as the Mag 7s, are making up such an increasingly large percentage of the index. And the point really is here is, look, if NVIDIA as the leader of maybe stocks just writ large, but certainly of the semi space, if that just pauses a little bit and the wind comes out of that sail just a little bit, that can really lead to some of this broader consolidation just off of knock-on effects, right? Broadcom's going to lose its call skew. SMH has that call skew. It's going to come down. Soxel, TQ, all stuff's just going to take a breather, right? And I think that could be within earnings on 221. That could really be a catalyst just for some change.
Yeah, I would have never guessed Broadcom is bigger than Tesla.
Yeah, I was shocked by that, to be honest with you. And I check this fairly often. So, and a lot of these other names are the names that we all know, but you also look at, you have JP Morgan and UNH are 1%, but then suddenly ExxonMobil's only 1% of the index now. MasterCard, Johnson Johnson, Procter & Gamble, all that's sub 1%. Costco, 76 basis points of the index. So, the top 2, 4, 6, 15, 20% or whatever of the S&P 500 is pure tech and semis now. So it's really very concentrated. Yeah. So one of the things I want to bring up here is that I think some of the bullish the bulls here would say that, look, maybe the rally is broadening out and, we haven't hit peak kind of craziness yet. And there are still a couple of metrics here that suggest that, again, maybe we get some consolidation here around Fed OPEX as I expect, but does that say a top is in for the year and that we've hit kind of like all-time, craziness? This is call volume here in blue versus put volume. And as you can see, we're up against highs that we've seen in 2021 and a couple of episodic spikes, I would say, in 2022. So there's a little bit more room, you could say, for call volume to go in terms of records. There's been a couple of times in history, like I can remember early February, there was just this day where call volume printed, like a standard deviation higher than the record. And, or the days around it, I should say. And it was so obvious to blow off top. And we haven't quite hit that, single day blow off top metric. And I think you could see that by the fact that we haven't had that new high yet in call volume. And I would wager that we'd probably see that at some point this year as we move towards the election, as the, government apparatus or fiscal monetary policy aligns to sort of support markets. I'm told that's how it may work this year. It seems like either not to talk politics, but you want to support the market for Biden, or on the other side of the equation, Trump says that people are just getting excited about him becoming president, which means the market's going to go up. So in either case, whether you're red or blue, stock market allegedly is supposed to go up because of politics. And then I wanted to show this chart here in teal. Is the interesting line on this chart is equity call buying premium spent, and this comes from the OCC. They tell us this each week. Last week was a huge surge in call buying premium, as you can see, this last lineup. But we're still well off of 2021 and 22 highs even. Early in 2022, there was a lot of trying to early buy the dips. So, look, in 2020, we had direct stimmy payments, right, to everyone's house, and we were all stuck at home because of COVID, and we're probably not in that same environment. But I don't think I've seen yet that retail gets sucked into this kind of late stage rally, right? Like, Jack, I don't know if your wife is investing or your, drinking buddy on the street saying, hey, I finally bought, NVIDIA, or I'm finally in the crypto trader. For me, it's my mom. When my mom asked me about, some kind of thing, okay, like I think the kind of top is in here. But I don't think we've gotten to that stage yet. So yes, consolidation is due. And this will bring me to kind of my last point here. If my level's 4,900, if we break 4,900 in the S&P to the downside, then it's not a consolidation anymore. We could move all the way down to 4,900 and I'd frame it as a consolidation, as a buy the dip opportunity. Below 4,900 is where we start to pay the piper for the put selling, the extreme call buying, then volatility, I think, spikes meaningfully. And we have a much more significant drawdown. This kind of thing where, you have the VIX go from 15 to 20, right? Like suddenly it just gaps like magnitudes of order higher. But into 4,900, expect that, remember that fixed strike vol matrix showing us that people are selling puts into these levels and that kind of thing. So we're watching that. Again, CPI tomorrow, which is the 13th, VIX expiration of the Wednesday. So 2 days from now, into NVIDIA earnings. I think there's all these catalysts kind of break this market momentum, and lead to some consolidation in markets.
Yeah, it'll be interesting to see how this plays out. These things are, you can see the signs of people getting a little overly optimistic, but as we've talked about before, the timing on this stuff is really hard. It was interesting. Like one of the guys I follow who's very smart on the growth side, on Twitter, was talking about, like, he thinks in terms of like the AI bubble, we're in like 1995 right now, that like we haven't even gotten started. So, and he thinks the AI is a much bigger thing than the internet was. So he thinks the bubble is going to be bigger than the internet bubble. So, we're obviously a long way from that, and there'll be a lot that goes on in the options market before we get there. But it was just an interesting perspective, which is the opposite kind of mine.
Yeah, and to that point, I mean, most of the options volume now is 30 days or less, right? And so when you look at these positions, like, and you're talking about the macro effects writ large, that's kind of the window that I'm looking into. Now, sometimes you have situations where a stock drops, like PayPal just dropped whatever it was, 10%, right? And you can see longer term options buyers come in or sellers come in, and you can make some longer term investment decisions off of options flows based on, short term movements, right? So there's a lot of value in that. And you were talking about some of these more macro things like this. We're in this overbought condition. I think that's pretty clear based on all of this data. And so, is that just going to be, again, consolidation? Then we continue to go to all-time highs like your growth investor buddy, suggests? Could be. I'm not really sure. if we're going to talk about like an all-time low, like in a March COVID crash scenario, that's where some of the options flow can really help out. But right now, this is flashing overheated. If you've ever had a car that's overheated, you got to let it cool down for a minute, and then you can kind of start it back up. And that's sort of the thing that I think I see at the moment. But again, you'd have to see those flows reinitiate after the weakness.
Before we wrap up here, I know you guys are doing a volatility challenge at Spot Gamma, and you just wanted to talk briefly about that.
Yeah, thanks for that opportunity, Jack. If you go to volatilitychallenge.com, we are running a series of webinars, basically. The next 3 weeks, they're free. So we're going to have one tomorrow. That's the 12th. And then next week as well. And the following week. And then after that, we have actually a paid course, which we're going to get into all of these different ideas. So if you need a refresher on skew and term structure and how you can use that for trading, or just what is that informing me of the market? I think a lot of people, even if you just trade stock, there's a lot to be gleaned from looking at options implied volatility. So people go, oh, I don't trade options. I don't need to care what like fixed strike vol is doing. I actually don't think that's true. You can get a lot of great information off of how the options market's pricing things in, how traders are leaning, bullish or bearish. And so we're going to go through all of these different things with, case studies and the like. And so if you go to volatilitychallenge.com, you can check that out. And we would love to have everybody here.
And to your point, like I'm a long-term fundamental investor, but like learning this stuff is just helped me understand, I think everybody, it's good to understand like what you're seeing on a day-to-day basis in the market. And like understanding this stuff, like helps you understand what you're actually seeing, even if you're not utilizing it in your investment process. Like there's just so much I've learned around dealer flows and volatility and, all this stuff that made things, understandable that I never would have understood before.
Yeah. And there's an undoubtable increase in derivatives, and, every once in a while it becomes the topic du jour. It was, maybe it was Volmageddon, but now a lot of people talk about the impact of these call overriding funds, for example, and what is that doing to volatility, and what's that, risk that's embedded in there. If you see the VIX spiking, right, into certain events, it informs you of how that event is being priced out by traders, right? And you can glean different information. So somebody, even though you're a longer term allocator, you're looking for moments to buy or sell, or moments to make really big, large, just strategic decisions. And there's an immense amount of information embedded in those options flows, and also in the way that implied volatilities are shifting as well. So, I think there's a lot to be applied for investors of all types.
Yeah, and I think that's a great note to wrap up on. We'll see everybody next month.
Awesome. Thanks so much.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Alydia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Alydia Capital.